Saw a bit of a pullback in the markets yesterday. We saw yields rise as well. That's obviously part of that whole dynamic there. In your mind, how much of the rally that we saw in Q1, how much is it dependent on the idea that we are getting those Fed rate cuts, that we're getting possibly as many as 3, and that they're coming sooner than later?
I think it's a big part of the rally, right? I think the market's resilience in the face of taking 3 to 4 rate cuts out of the forecast, which we did in Q1. The market entered the year looking for 6 to 7, to pare it down to 3 and still have a 10% plus gain and see the breadth and momentum continue, I think is a typical of the resilience here. But you do need to continue to at least see a dovish tilt from the Fed. That is a hint towards rate cuts rather than holding firm all year or looking for even rate hikes later in the year. If manufacturing activity, economic activity reaccelerates, or inflation just proves too sticky to get down to that 2% target. So I think it's important.
All right, so that manufacturing data and PCE from Friday had a big impact on the markets yesterday. You're looking ahead, actually, at jobs data, both the JOLTS and, of course, the monthly jobs report. In your mind, what do those mean for the market and for some of the rally that we've seen and also some of the broadening that we've seen in the market?
Well, I think it means everything, right? The Fed has a dual mandate. They've focused on inflation, entirely over the past couple of years, but they can't ignore the job market. And I think they will get a lot more dovish at even a hint or a whiff of weakness in the labor market. We've seen some cracks, some normalization back to pre-COVID trends. In the JOLTS report, we look at the quits rate. Initial claims are still quite low, but I think even a hint of weakness in the job market will shift this narrative from a hawkish Fed to a more dovish Fed pretty quickly, because they're watching that dual mandate closely and because the consumer spending story has been very much predicated on a solid job market. If that gives way even a little bit, I think you'll see this shift in markets towards more of a dovish tilt, and that soft landing talk, get a little quaky. Now, markets will like it if yields pull back, but at the same time, you need the job market to support the economic activity we've seen.
All right, so, we're getting we received some mixed information when it came to that manufacturing data and also PCE. You say we're also looking ahead to jobs. In your mind, just in general, what's the sentiment of the market right now? As we look ahead to Q2, what are you seeing in the market right now? Are we still seeing the same bullishness? Are we starting to see some cautious optimism? What's your view?
Bullish, but not euphoric, right? So it's not 2021. We're not seeing, you're seeing a little bit of IPO activity pick up. You're seeing some risk on sentiment, and things are bullish, right? The survey data is bullish. The options positioning data is pretty bullish, but not euphoric, not over the top, the kind of thing where you need bull market or bulls to kind of propel a bull market. And I think we're in that phase now. Could we see a kind of tidy consolidation period here? And are we seeing that right now? I think it's possible. The market needs a reason to sell off every now and then. But I would say bullish, not euphoric, is where we sit today, and that's just fine for where we're at in the bull market.